Warriors, rise. Wow. Are you ready for this, Warriors? Are you ready for the red pill? Your banks are scams. My name is Coach JV. I'm the top health, mindset, and crypto coach in the world. Remember, what you believe in your heart, you think in your mind, will eventually become your words and become your reality. If you can see it in your mind, eventually you can hold it right here in your hands. What you repeatedly do gets ingrained in your subconscious mind. What gets ingrained in your subconscious mind becomes an unconscious activity. Now, that last statement is probably the most important statement of all, Warriors, because you've been predictive programmed into a just over broke system, an indoctrination system, and you were raised in the banking system. So you're not expected to know how the banking system works. You just know that you need to go to school, get a job, get your credit card, get your auto loan, get a 30-year mortgage, fight till Friday to get your paycheck, to pay that debt, to once you get out of debt, to get buried back in debt. Because if you don't, Warriors, if you paid off all your debt, the whole economy would collapse. Every dollar you have in your hand, when somebody hands you a dollar, that is someone else's debt. Do you realize that? That every single dollar you have is debt. That's all it is, Warriors. If we were doing what they were doing, we'd probably be in jail. So what we're going to do is you're going to watch a 14-minute clip of a documentary called The Zygotus Addendum. Okay, I highly recommend. I'm going to show you the documentary at the end. Do you want to give credit where credit is due? If you want to find this clip, it is the YouTube channel TAEONU. He did a great job of pulling this clip together. It's a 14-minute clip. It's going to take a little bit, but I want you to soak this up. I want you to absorb this on this Friday, okay? And just let it sink in. Then I'm going to show you facts, figures, numbers, logic of where we're at in our society right now. Here we go.
A number of years ago, the Central Bank of the United States, the Federal Reserve, produced a document entitled Modern Money Mechanics. This publication detailed the institutionalized practice of money creation as utilized by the Federal Reserve and the web of global commercial banks it supports. On the opening page, the document states its objective. The purpose of this booklet is to describe the basic process of money creation in a fractional reserve banking system. It then proceeds to describe this fractional reserve process through various banking terminology, a translation of which goes something like this. The United States government decides it needs some money, so it calls up the Federal Reserve and requests, say, $10 billion. The Fed replies, saying, sure, we'll buy $10 billion in government bonds from you. So the government takes some pieces of paper, paints some official-looking designs on them, and calls them treasury bonds. Then it puts a value on these bonds to the sum of $10 billion and sends them over to the Fed. In turn, the people at the Fed draw up a bunch of impressive pieces of paper themselves, only this time calling them Federal Reserve notes, also designating a value of $10 billion to the set. The Fed then takes these notes and trades them for the bonds. Once this exchange is complete, the government then takes the $10 billion in Federal Reserve notes and deposits it into a bank account. And upon this deposit, the paper notes officially become legal tender money, adding $10 billion to the U.S. money supply. And there it is. $10 billion in new money has been created. Of course, this example is a generalization, for, in reality, this transaction would occur electronically, with no paper used at all. In fact, only 3% of the U.S. money supply exists in physical currency. The other 97% essentially exists in computers alone. Now, government bonds are, by design, instruments of debt. And when the Fed purchases these bonds, with money it essentially created out of thin air, the government is actually promising to pay back that money to the Fed. In other words, the money was created out of debt. This mind-numbing paradox of how money or value can be created out of debt or a liability will become more clear as we further this exercise. So the exchange has been made, and now $10 billion sits in a commercial bank account. Here's where it gets really interesting. For as based on the fractional reserve practice, that $10 billion deposit instantly becomes part of the bank's reserves, just as all deposits do. And regarding reserve requirements, as stated in modern money mechanics, a bank must maintain legally required reserves equal to a prescribed percentage of its deposits. It then quantifies this by stating, under current regulations, the reserve requirement against most transaction accounts is 10%. This means that with a $10 billion deposit, 10% or $1 billion is held as the required reserve, while the other $9 billion is considered an excessive reserve and can be used as the basis for new loans. Now, it is logical to assume that this $9 billion is literally coming out of the existing $10 billion deposit. However, this is actually not the case. What really happens is that the $9 billion is simply created out of thin air on top of the existing $10 billion deposit. This is how the money supply is expanded. As stated in modern money mechanics, of course they, the banks, do not really pay out loans from the money they receive as deposits. If they did this, no additional money would be created. What they do when they make loans is to accept promissory notes, loan contracts, in exchange for credits, money, to the borrower's transaction accounts. In other words, the $9 billion can be created out of nothing simply because there is a demand for such a loan and that there is a $10 billion deposit to satisfy the reserve requirements. Now, let's assume that somebody walks into this bank and borrows the newly available $9 billion. They will then most likely take that money and deposit it into their own bank account. The process then repeats, for that deposit becomes part of the bank's reserves. 10% is isolated, and in turn 90% of the $9 billion, or $8.1 billion, is now available as newly created money for more loans. And of course, that 8.1 can be loaned out and redeposited, creating an additional 7.2 billion to 6.5 billion to 5.9 billion, etc. This deposit money creation loan cycle can technically go on to infinity. The average mathematical result is that about $90 billion can be created on top of the original 10 billion. In other words, for every deposit that ever occurs in the banking system, about 9 times that amount can be created out of thin air.
Money jitters. Ask the obliging Bank of America for a jar of soothing instant money, M-O-N-E-Y, in the form of a convenient personal loan.
So, now that we understand how money is created by this fractional reserve banking system, a logical yet elusive question might come to mind. What is actually giving this newly created money value? The answer? The money that already exists. The new money essentially steals value from the existing money supply. For the total pool of money is being increased irrespective to demand for goods and services. And as supply and demand finds equilibrium, prices rise, diminishing the purchasing power of each individual dollar. This is generally referred to as inflation, and inflation is essentially a hidden tax on the public.
What is the advice that you generally get? And that is inflate the currency. They don't say debase the currency. They don't say devalue the currency. They don't say cheat the people who are saved. They say lower the interest rates. The real deception is when we distort the value of money. When we create money out of thin air, we have no savings, yet there's so-called capital. So my question boils down to this: how in the world can we expect to solve the problems of inflation, that is, the increase in the supply of money, with more inflation?
Of course, it can't. The fractional reserve system of monetary expansion is inherently inflationary. For the act of expanding the money supply, without there being a proportional expansion of goods and services in the economy, will always debase a currency. In fact, a quick glance at the historical values of the US dollar versus the money supply reflects this point definitively, for the inverse relationship is obvious. $1 in 1913 required $21.60 in 2007 to match value. That is a 96% devaluation since the Federal Reserve came into existence. Now, if this reality of inherent and perpetual inflation seems absurd and economically self-defeating, hold that thought, for absurdity is an understatement in regard to how our financial system really operates. For in our financial system, money is debt, and debt is money. Here is a chart of the U.S. money supply from 1950 to 2006. Here is a chart of the U.S. national debt for the same period. How interesting it is that the trends are virtually the same. For the more money there is, the more debt there is. The more debt there is, the more money there is. To put it a different way, every single dollar in your wallet is owed to somebody by somebody. For remember, the only way the money can come into existence is from loans. Therefore, if everyone in the country were able to pay off all debts, including the government, there would not be $1 in circulation. In fact, the last time in American history the national debt was completely paid off was in 1835 after President Andrew Jackson shut down the central bank that preceded the Federal Reserve. In fact, Jackson's entire political platform essentially revolved around his commitment to shut down the central bank, stating at one point, "The bold efforts the present bank has made to control the government are but premonitions of the fate that awaits the American people, should they be deluded into a perpetuation of this institution or the establishment of another like it." Unfortunately, his message was short-lived, and the international bankers succeeded to install another central bank in 1913, the Federal Reserve. And as long as this institution exists, perpetual debt is guaranteed. Now, so far we have discussed the reality that money is created out of debt through loans. These loans are based on a bank's reserves, and reserves are derived from deposits. And through this fractional reserve system, any one deposit can create 9 times its original value, in turn debasing the existing money supply, raising prices in society. And since all this money is created out of debt and circulated randomly through commerce, people become detached from their original debt, and a disequilibrium exists where people are forced to compete for labor in order to pull enough money out of the money supply to cover their costs of living. As dysfunctional and backwards as all of this might seem, there is still one thing we have omitted from this equation. And it is this element of the structure which reveals the truly fraudulent nature of the system itself: the application of interest. When the government borrows money from the Fed, or when a person borrows money from a bank, it almost always has to be paid back with accrued interest. In other words, almost every single dollar that exists must be eventually returned to a bank with interest paid as well. But if all money is borrowed from the central bank and is expanded by commercial banks through loans, only what would be referred to as the principal is being created in the money supply. So then, where is the money to cover all of the interest that is charged? Nowhere. It doesn't exist. The ramifications of this are staggering, for the amount of money owed back to the banks will always exceed the amount of money that is available in circulation. This is why inflation is a constant in the economy, for new money is always needed to help cover the perpetual deficit built into the system, caused by the need to pay the interest. What this also means is that mathematically, defaults and bankruptcy are literally built into the system, and there will always be poor pockets of society that get the short end of the stick. An analogy would be a game of musical chairs, for once the music stops, somebody is left out to dry. And that's the point. It invariably transfers true wealth from the individual to the banks. For if you are unable to pay for your mortgage, they will take your property. This is particularly enraging when you realize that not only is such a default inevitable due to the fractional reserve practice, but also because of the fact that the money that the bank loaned to you didn't even legally exist in the first place. In 1969, there was a Minnesota court case involving a man named Jerome Daly, who was challenging the foreclosure of his home by the bank which provided the loan to purchase it. His argument was that the mortgage contract required both parties, being he and the bank, each put up a legitimate form of property for the exchange. In legal language, this is called consideration. Mr. Daly explained that the money was, in fact, not the property of the bank, for it was created out of nothing as soon as the loan agreement was signed. Remember what modern money mechanics stated about loans? What they do when they make loans is to accept promissory notes in exchange for credits. Reserves are unchanged by the loan transactions, but deposit credits constitute new additions to the total deposits of the banking system. In other words, the money doesn't come out of their existing assets. The bank is simply inventing it, putting up nothing of its own, except for a theoretical liability on paper. As the court case progressed, the bank's president, Mr. Morgan, took the stand, and in the judge's personal memorandum, he recalled that the plaintiff, bank's president, admitted that, in combination with the Federal Reserve Bank, did create the money and credit upon its books by bookkeeping entry. The money and credit first came into existence when they created it. Mr. Morgan admitted that no United States law or statute existed which gave him the right to do this. A lawful consideration must exist and be tendered to support the note. The jury found that there was no lawful consideration, and I agree. He also poetically added, only God can create something of value out of nothing. And upon this revelation, the court rejected the bank's claim for foreclosure, and Daly kept his home. The implications of this court decision are immense. For every time you borrow money from a bank, whether it is a mortgage loan or a credit card charge, the money given to you is not only counterfeit, it is an illegitimate form of consideration, and hence voids the contract to repay, for the bank never had the money as property to begin with. Unfortunately, such legal realizations are suppressed and ignored, and the game of perpetual wealth transfer and perpetual debt continues. And this brings us to the ultimate question. Why?
All right, Warriors. All right. So I've been telling you guys this for a long time, right? I was in the banking system, 12 years in banking. And when I realized, excuse me, let me shut this down here. When I realized that the banking system was set up this way. When I was CBA executive banking school, wasn't the smartest cat in the world, so I had to study really hard. And we started to scale those banks in that SIM model. And I kept asking the question, where does this money come from? I started to question everything. And I realized that if I was doing the exact same thing they were doing, I'd probably be in jail, Warriors. Think about that for just a moment. If you were doing what they're doing, printing money out of thin air, putting something of value, right? They're giving you a loan for a home that they have nothing. It wasn't created out of anything. They used money that had no value to give you a loan, to charge you interest. And if we all paid off our debt, the whole economy would collapse. Well, this right here is the actual document. So let's go here. You can look at this yourself. It's called the Modern Money Mechanics. You can read through the whole thing. So it's a workbook on bank reserves and deposit expansion. So if you go here to page 6, you can see exactly what they're talking about here. I just want to show you the facts, figures, numbers, logic, so you're not just hearing it on a video. Right here, it says under current regulations, the reserves requirement against most transaction accounts is 10%. Assuming for simplicity, a uniform 10% reserve requirement against all transaction deposits, and further assuming all banks attempt to remain fully invested, we can now trace the process of that expansion in deposits, which can take place on the basis of additional reserves provided by the Federal Reserve System purchases of U.S. government securities. It's a Ponzi scheme, Warriors. That's all it is. So they only have to keep 10% of your deposit, right? But remember, so for example, to start a small business, you get a loan, right? That loan, you pay your employees through the income you generate through the people coming through your doors. But everything is debt, right? The people coming into your doors were paid by somebody who got debt to start that business, right? Then you take your hard-earned money from the profits of the business, and that business owner owns a mortgage and owns a car and has a credit card. So everybody is keeping the system going. We are just the machines, the little robots in the machine that keep the system going. The wealthy people are not running the same system you are. Once I figured that out 2 years ago, I do not operate in the same type of system, warriors. Everything I buy now is an asset. An asset. Took me 2 years to figure this out, and my whole life has changed, warriors. Okay, so this is the actual document right there. But I'm going to show you at the end that they actually have rechanged the reserve requirements to 0% needing to be held. So 0% of your money needs to be held, and they can lend out 100% of it. Okay, now where did this start? When President Nixon ended the gold standard in 1971. So inflation was on the rise and gold run was looming. President Nixon's team enacted a plan that ended the dollar convertibility to gold and implemented wage price controls, which soon brought the end to the Bretton Woods system. So he just comes on a regular program show and then shuts down the gold standard. So then your money was backed by nothing. And since then, let's take a look at this. This is your money supply since around 1971, just stacked. And so you can look all this stuff up. This M1 Money Report, warriors. This is going into 2020. And we printed more money. Now I'm going to show you something pretty powerful. Okay. So let's just look at this. So let's look at 2000. Okay. See these yellow lines right here? These are financial collapses. 1990, right at the around 1990s, we had a financial collapse. Was that around 2001? We had a big catastrophic collapse, right? And then right around here, right? 2008. Remember that? And then boom, what was created right here, warriors? Bitcoin. 2009. And since Bitcoin's inception, you're going to see a massive increase in the money supply. Does that tell you that they're switching the monetary system? They knew that the car was about to crash, so they started pumping money into the system, taking that money, investing in assets as the poor became poor and the rich become richer. Well, here's the public debt. It's right in a line. We got 1990 to 2021, right after 2020. Look at the public debt, money supply, public debt. Money supply, public debt. It's completely tied together, warriors. Now we have a stock market that's overvalued by 215%. This is the annualized GDP, gross domestic product, divided by the value of the companies. So what Warren Buffett's indicator says is that our stock market is overvalued by 215%. It's because of this bullshit right here, this money printing, because all these companies got stimulus checks, bailout checks, PPP loans, barely any interest, no payment, freaking SBA loans, right? All this stuff was pumped into these businesses. So there truly is no GDP growth. So they're really, really, really super overvalued. So remember, look at this money supply since 2009. Since Bitcoin's inception, the money supply has gone just catabolic. That'll be the opposite. Part of bodybuilding, parabolic, right? Okay, now let's look at this. Here's Bitcoin. You got Bitcoin 2010. Look, it's kind of steady. Boom, spikes up, comes down, and then boom. Bitcoin skyrockets, warriors, as the money supply skyrockets. Look at that right on the back end here. Look at the money supply. Boom. Look at Bitcoin. Money supply, Bitcoin. There's a connection here, warriors. There's absolutely a connection. And you can see here the market capitalization of Bitcoin, April 2013 to November 8th, 2021. So you look at this right here. Look at this. Look at the increase in the market cap, warriors. This is a legit access class or assets. Well, I'm freaking tired. Asset class, warriors. Think about that. It's all by design. You can't keep kicking the can down the road, warriors. You can't. So what do? You switch the whole monetary system. Okay, well, JV, at least they can keep 10% of your money in the bank. They have to, right? Well, nope. They changed the rules. November 2019. This is right here. This is the Reserve Maintenance Manual. Okay, you go here. This is what I do. I read all these documents. I love this stuff. I absolutely love doing this stuff. Okay, so it says, as announced, March 15th, 2020, the board reserve requirement ratios to 0%. Effective March 26th, 2020. This action eliminates reserve requirements for all depository institutions. This archives the manual, provides additional details on how reserve requirements were administered prior to the change in reserve requirement ratios to 0. It was last updated November 20th, 2020, and will no longer be modified. Your banks have to hold 0% of your money. They can lend out 100%. So 2020, they can now lend out 100% of your money. Bitcoin is going completely parabolic. as the money supply goes completely parabolic, as the US debt is out of control, an overvalued stock market, and all the elites are flooding into cryptocurrency and blockchain. Think about that just for a minute, warriors. Bitcoin skyrocketed. Gold barely went up. S&P barely went up. And oil went down in the last year. Let me repeat that. Bitcoin went parabolic. Oil went down. S&P barely went up. I mean, just normal. And then gold barely went up compared to Bitcoin. What does that tell you, warriors? Where are we heading to? And now the Federal Reserve, or excuse me, the banks have to hold zero of your money on deposit. They can lend out 100% of your money. So welcome to the money casino, warriors. This is it. That's the red pill, warriors. Now you have to wrestle with this. And I'll tell you what, Ken Mack and I on Monday, we're going to make an announcement. We're going to be launching something called the Red Pill Bootcamp to take you through stuff like this, to open up your mind and awareness and allow you to wrestle with it, warriors, because this is deep shit. This is deep stuff to accept, warriors, because you're taught the CNN economics. You have these people, talking heads, go on there. They're not going to tell you the truth, warriors. Think about that for just a moment. And I get it. I get it. This is not for you to trust a word I'm saying, but this is how the system works, warriors. I didn't create the system, but I sure as hell am not going to live in the system. What I mean by that is I'm creating my own ecosystem. I'm doing what the elites are doing, and I built financial freedom for myself. And a lot of warriors. So I love you guys. This is not fear mongering. This is not to scare you. This is just reality, warriors. And now that you have the red pill, you have a choice. You can take the blue pill and go and start to change your life for generations to come. Warriors, rise. Let's go.